European bank failures. When do they go globally systemic? Who decides? How do we discern? The 2007 to 2009 financial crisis was global in scope and most certainly not a one-off historical event.
There is a little bit of a consternation down here about there being no bell. Our market reporters are standing by. Bob Pisani, have you ever seen anything like no bell?
Yeah, that's a little strange here.
Let's talk about the speed with which we are watching this market deteriorate. What in the world is happening on Wall Street?
I have never live looked at the Dow Jones Industrial Board and seen a 600-point loss.
Who knows where this is going to end up? I mean, this is volatility we haven't seen, of course, since way before you and I were born.
So almost everything there completely wiped out. And the NASDAQ, everything and more has been completely wiped out.
The Dow traders are standing there watching in amazement, and I don't blame them. The credit market...
It was the worst day on Wall Street since the crash of 1987.
What started in America last year has now spread to every part of the world.
We're down 9% today. The Xetra DAX over in Frankfurt is down by 9%. The Paris market down by 9%. Austria, which was briefly suspended earlier on in the day, is down by nearly 11%.
We're in the last days of this country surviving.
We've seen triple-digit swings in the stock market. Major financial institutions have teetered on the edge of collapse, and some have failed. We are in the midst of a serious financial crisis, and the federal government is responding with decisive action.
Yet the means deployed to contain it by the world's central and private banks, as well as their corresponding governments and other regulatory bodies, ultimately served only to kick fiscal cans down the road. The levels of both public and private debt in the world stand at unprecedented levels, and it's only a matter of time, or possibly even a function of a kill switch or three, thrown somewhere on high within hyper-exclusive financial power centers before another severe crisis takes place, and one of a larger scale than that of a decade ago. So when and how would this second leg, as it were, of an extended global deflationary cycle commence? What events would trigger it? Could such events be prudently forecast, let alone prevented? Let's look at Europe recently for hints. 4 European banks have failed over the past 8 months alone, giving strong indications that another corrective brink may be at hand. These institutions were Banco Popular of Spain and 3 Italian banks, Monte dei Paschi di Siena, or MPS, Veneto Banca, and Banca Popolare di Vicenza. Popular was taken over by rival Spanish Banco Santander with help from the European Union. MPS was taken over by the Italian government in state recapitalization, and the latter 2 banks in Italy were also assumed by Rome in order to split their, quote, good versus bad assets and liabilities between Italy's largest private bank and the Italian state, respectively. Meanwhile, Italian citizens will bear the approximately 5 billion to 6 billion euro immediate cost of these latter Italian twin bailouts on top of their lost savings. Senior bondholders received protection by the Italian government, whereas junior creditors and the bank's shareholders lost their shirts via this quote-unquote rescue. Now, the use of taxpayer money for the Veneto and Vicenza bailouts went against the provisions established by the European Commission and by the European Central Bank, ultimately revealing the frantic states reached in conducting such emergency measures, despite lack of admission from banking and government officials. There were political reasons for handling the twin bailouts with such haste, but also presumably reasons involving the need for averting systemic fiscal risks from spiking. The former reasons tend to be emphasized in the mainstream corporate and financial press. The latter reasons involving systemic risk, not so much. Warning in early June of the potential for a systemic crisis, the Italian economy undersecretary himself stated that, quote, the collapse of 2 regional banks in Italy's Veneto region would have triggered a systemic crisis that would have risked dragging down the whole domestic economy. Brussels thus got out of the way of timber falling, and especially by avoiding their prescribed bail-in procedures, which would have caused outright public panic in these instances. This is all a mere hint of what's expected to come further, both in Italy as well as other highly debt-plagued European Union economies. Why? For one, monstrously unprecedented levels of private and public continental debt. The twin Venetian bank failures are consistently portrayed as small and thus relatively insignificant events. Yet this ignores the systemic basis of risks which sit latent in many European Union financial institutions due to their derivatives and off-balance sheet exposures. As of the fall of 2016, the stock index of Italian banks and that of Deutsche Bank of Germany, which retains over 46 trillion, that's with a T, $46 trillion worth of gross derivatives risk exposure, as well as questions regarding its solvency health, had been moving in tandem despite Deutsche Bank and those Italian banks carrying different challenges. If you were to look at the graph, which you'll see in the exclusive piece that I had written with regard to this subject, you look at a graph of the performance of Deutsche Bank's debt as well as the collective of the Italian banking sector's performance, you'll see that there's a correlation that's a little too frightening to ignore. Deutsche Bank doesn't have the Italian banks' non-performing loan problems. And yet why this correlated graphical chart movement? Perhaps it's because Deutsche Bank is so risk exposed to Italy that an Italian banking crisis would eventually pose contagion on a multiple size of what happened in 2008. Listen, these banks are already zombie banks, quote unquote, meaning that they're walking insolvent in real time mark-to-market scenarios. Yet they're not officially bankrupt yet. So what, or better yet, who could or would tip the perceptual balance into crisis mode? During negotiations for bailing out Monte dei Paschi Bank of Italy, not only did JP Morgan of New York walk away, but so did two prominent New York hedge funds, Fortress and Elliott. Both hedge funds, essentially, despite them being offered 80% markdowns on Monte dei Paschi's non-performing loans, they nonetheless walked away despite that markdown, which clearly was not enough to attract such private investors to stay involved in bailout. Then the government stepped in after these private institutions stepped away. So can such government interventions continue under such rising duress and growing lack of consumer and institutional confidence? Or will that lack of confidence be used as excuses for eventually pulling funding support for banks that need to be consolidated? As with the 2007 through the 2009 crisis, there is an inevitable widespread transatlantic shrinkage expected in the number of banks out there, and not only by fiscal necessity, but by longer-term design as well. In such a game, the largest global banks routinely stand to assign, rearrange, or outright vacuum up the assets of quote-unquote expendable banks deemed necessary to be culled. In Europe, the Club Med or Mediterranean nations' banks are seemingly more expendable and ripe for consolidation versus, say, German or French mega banks like BNP Paribas, Société Générale of France, or Deutsche Bank of Germany. Who assigns and executes such wash and rinse cycles? How frequently and why ultimately? Is the European Commission itself co-tasked with such bank consolidation duties? How much have the 2008 and imminent financial crises served or will serve for wider sweeping macro strategic imperatives and expected debt jubilees amongst the West's largest banks? For global financial governing bodies such as the IMF and Bank for International Settlements in Switzerland? What extensive longer-term international money order is being sought through this creative destruction involving periodic transatlantic asset consolidation? Italy's general banking sector and banking foundation is so fragile and a viable market for accommodating deteriorated credit so lacking that it has not been able to offload its estimated 360 billion euro of non-performing loans, many of them with very weak, if any, remaining collateral underpinning them. On average, they are marked at around 50 cents on the euro. Italy's debt to GDP ratio is in excess of a shocking 130%. Its national youth unemployment is north of 37%, with overall official unemployment at 11.3%, which is well over twice that of the official U.S. unemployment rate. And the labor force participation rate in Italy is only at 65%. Out of 500 Italian banks, a full 114 are high risk, meaning that they don't have enough capital to cover all the bad stuff on their books. What would otherwise push these banks over the cliff? A systemic event triggered foremost by a derivatives meltdown, either within Italy or certainly elsewhere, due to the opaquely defined counterparty relationships between institutions which have traded them? Systemic risk could easily spread from Europe to the United States, considering that, despite announced governmental figures painting economic indicators as generally healthy, the state of the U.S. economy is much worse off than advertised. The U.S. Fed's balance sheet ballooned from $869 billion to $4.5 trillion over the prior decade alone. Yet they're about to start tightening this, which will wreak havoc across markets. The U.S. consumer debt picture isn't pretty either. The fastest growing types of lazy borrowing have been student loans, credit cards, and auto debt. For much of these types of debt, there is either no collateral, as with credit card loans, or collateral whose value declines over time, as with cars. These latest iterations of financial engineering are not sustainable. There's also little to no wage growth in the U.S. economy, which hampers not just consumption trends, but savings, investment, and yes, debt servicing as futile. On top of this, consumers are more reliant on credit to make their way anyway. Italy's banking fiasco can thus easily infect not simply its neighboring European Union economies, but spread globally based on the very nature of modern global finance's complexities. For the serious observer, the tools required for truly making sense of all of this will extend well beyond surface-level academic and even corporate prescribed tools. You simply cannot take officially prescribed information on its surface as a given. And that wraps up our inaugural program of Money and Fear with yours truly, Pi Ian. This particular program, this inaugural program, is premiering and will be available to everyone to see. In order to see all the future programs, however, you will need to be a member of Newsbud's growing community. Newsbud is an amazing, very rare, very steeped, very skilled news platform and network. We ask that you please consider joining this unique information resource on a very affordable basis in order to not only get full access to future programs of Money and Fear, but to all the exclusive information and data and programs that are offered through the Newsbud community. Thanks so much.
For just a small subscription fee, you can become a member of the Newsbud community and help keep this website running. Your subscription will provide you with full community access to exclusive content, including videos and articles from Newsbud's team of experts and analysts, as well as a members-only monthly newsletter from Newsbud's founder, Sibel Edmonds. Sign up today for full access at newsbud.com.